Well, welcome everybody. Thank you for joining us for Basic Investment Concepts. My name is Jordan Thorson. I'm a communications assistant with UFHR Communications and Work Life. And our presenters are UF IFAS Hillsborough County Extension Agent Lisa Leslie, and also Okaloosa and Walton County's Extension Agent Breslawski. Thank you so much for joining us today.
Thank you.
Let's see, so just some housekeeping before we jump in. Our webinar is going to be recorded. It's going to be uploaded to YouTube and our WorkLife website. So if you have to leave early, you'll have that resource available to you afterwards. That being said, since it is being recorded, you are welcome to turn off your cameras so you're not being recorded. But if you'd like to keep them on, our speakers love talking to real faces, so completely up to you. Questions will be taken during. If you have something that's related to the topic that they're speaking of currently, you're welcome to unmute yourself or put it in the chat, and we'll try to answer those questions along the way. If you have a question in the chat that we don't have time to get to during the presentation, I'll be keeping track and we can ask them at the end of the presentations during a more formal Q&A. And with that being said, I think we're ready to start. Jill, Lisa?
Thank you. And of course, I touched a button and now my screen's a little, let me see if I can just get back. I don't know what I did. Okay, I just need to move this. Okay, thanks everybody. So I think Lisa and I, we're gonna kind of divvy up this presentation for you all, but we hope we can answer some questions. If you're not familiar with UF IFAS Extension Services, we are a partnership between the University of Florida and local county governments. So in every county in Florida has an extension presence and office, and lots of our counterparts work there and can help answer some of the questions you may have today and more. Let's see. So today, again, we're going to provide general personal finance information. What we are not able to address is everything that applies to an individual and unique situation. So if you want more specific information, go ahead and you can feel free to email or call us, and we'll try and point you in the right direction. But again, we can't give specific investment advice, that type of thing. Following the webinar, we are going to have a short evaluation sent to everybody. And once you complete that evaluation, you can have access to our presentation, so the slides, for download so that you can review and look later. But it really does help us out if you give us that feedback. We use it to report the work that we do. And again, today we're going to cover basic investment concepts. So some of those, the underlying topics include foundational investment concepts. We're hoping to provide just good educational information. Again, not opinion, not investment advice, just information so that you can make the best decision for yourself. We're not going to be discussing speculative or complicated investment strategies. And some of the further topics we'll be discussing include time horizon, risk, asset allocation, financial professionals, and services that you can use to help you on this journey. So if you have questions or comments, those are welcome. Feel free to type into the chat if you like. If you're more comfortable asking those questions and they're timely, go ahead and unmute yourself if you like and ask us directly, and we'll do the best we can to answer. If we can't answer your question or we don't have time, then we will address it afterwards. Or you can feel free to email or contact us. Okay, so I think we're going to jump right into it. So something that should be considered when you're thinking about investing and where to start is your current kind of situation and status. So you're going to consider financial stability and your risk tolerance. And what that means is how likely is it that you can financially kind of handle the burden of a potential loss or fluctuation with your investments. So here we see on this graphic kind of a stack of blocks or pyramid kind of looking, and these are really some foundational things that you should have in place and should consider when you're talking about investment. So essentially, you'll want to review, does your income exceed your expenses? Okay, if the answer is no, maybe investing, taking your income and investing is not the right step for you. Do you have an emergency fund? So do you have at least anything saved in case the refrigerator goes out or you have job loss, something like that? A recommended emergency fund could be 3 to 6 months worth of pay. So I'm not saying that you should, have that immediately and start with that, but something to work up towards. Do you have manageable debt levels, or are you maybe living paycheck to paycheck just to get things paid? And are you already saving for future goals? So all of these items, are important to get kind of aligned and provide that solid financial foundation so that you can handle the risk and any instability that you may see during investing.
And that's a good point, Jill, because Dana put in the chat box about, is it always a good idea to max out contributions? So I think you just addressed that. Sometimes it may be, if you've got all these other things in place and you're good with your goals that you got and you can max things out, that could set you on a path towards early retirement. But and how much to contribute depends on your situation. If you start early in your work career, early in the life cycle, 10 to 15% may be fine. If you were like me and waited until you got a little more seasoned and you wanted to retire, then you might have to contribute more.
Exactly.
So I thought that was a good time to address that. Go ahead.
That is a good time. And you're going to discuss that a little bit more when you talk about risk and a little bit more in depth and time horizon. So yeah, good questions. Okay. And so something else to consider is your emotional risk tolerance. How will you handle market volatility? If you've got the majority of your funds tied up in the market, are you okay seeing that fluctuate and change? So because some days it can be a little scary. So you'll want to consider, how much can you handle yourself and how much can you handle the uncertainty of the day-to-day, because it truly is, investing truly does change day to day and sometimes more frequently. So in order to examine risk, there's a really cool tool that you can use, and this is from the University of Missouri, and it is the investment risk tolerance assessment. I think it's about like 13 questions, and they just kind of check in, see how you're doing, and sees how resilient you may be to risk, meaning can you bounce back if something happens and things didn't quite go your way as far as investing goes. Just a quick look at some product comparisons. So we've got savings products and investment products, both good things to have and things to know about saving and investing. Some things you should know is that savings are, considered to be quote unquote safe. Okay. There's a little bit more risk in investing. In savings, your principal, the money that you have or contribute, is safe and even insured. But in investing, your principal can be lost. Savings provides a lower return, and investing, you have potential for higher return. Again, inflation, we're going to talk a little bit more about this, but savings products don't tend to keep pace with inflation, especially when inflation's like 9%. And investment products are more likely to. And then there are some additional tax advantage rates and, depending on your goals, medium and long-term goals, kind of align a little bit more with the investment product or investing process. Okay. So why in the world would we take risk associated with investing? If you could, like my other slide said, lose your principal. Well, one reason are tax advantages. So retirement plans are one way that you can get a tax advantage, invest and take advantage of kind of tax breaks. So with certain retirement plans, like your traditional plans, the traditional IRA, you would have tax deductible contributions. So money that you put in would be tax deductible when you go to file, and you may not pay. It could reduce how much you pay on your taxes. Your Roth plan is going to earn tax exempt earnings. So when you invest in a Roth, say IRA, then when you pull out that money after retirement, or after you hit whatever age it will be when we get to that age, when you pull out that money, those earnings are tax exempt. So you have a couple different things. You getting either tax deductible contributions or tax exempt earnings. So on your traditional plan, it is important to know that tax deductible contribution and growth will be taxed when you withdraw that. Okay. College saving plans. These are an example is the 529 investment plan. This is another example of tax exempt growth that can be used to pay for qualifying educational programs. And a lot of it is college related, but some of it are different modes of education that can be paid for with these plans. And then, of course, there are investments held outside of a retirement plan. So these are long-term capital gains. You may benefit from dividends and the tax rates. And I know Lisa's going to talk more about capital gains tax rates in just a few minutes. And then, of course, we talked about inflation, right? And so why take the risk? Well, you're trying to beat inflation with your investment. So you're hoping that investing will at minimum, keep pace with inflation, if not beat it. And here's just an example of inflation. And that is if you had $1,000 in 2004, in order to have the same purchasing or buying power in 2024, then you would need $1,686.46. Now, typically, average savings plan will not keep pace with that, but investing could. It has a little bit more impact. Okay. And I think Lisa is going to talk a little bit more about this reward and risk.
Yeah, because as Jill said, you
Yeah.
kind of are almost forced to
Yeah.
take some risk
Yeah.
in hopes of a reward. And when you talk about a reward, it means as a sale of a stock or another asset that has a chance for appreciation grows in value. And then you sell, buy low, sell high. You'll make some money off that, hopefully. And you want to think about, though, as you hold an investment, whether you're going to have to pay taxes on ordinary income tax rates or the special long-term capital gains rates. So if you sell an investment that you've held for a year and a day, so more just longer than a year, you'll be taxed at special capital gains rates. 0% if you're at a low income rate, 15% for most of us, and for very high income people, that'd be about 20%. But again, that's just when you buy and sell it, or when you realize that gain. If you're just holding things, you don't sell it, then you won't have it. You'll just have what they call a paper gain. There, you haven't bought or sold. You can also have the risk is you can have a capital loss. You could sell at a price that it costs less than you bought it for. So then you're going to have a capital loss. People can use those losses to reduce the capital gains and tax liability. And we'll talk a little more about that as we go along. And one thing I want to point out is that, like in our retirement plans, it can be a goodness gracious as roller coaster. And somebody said they don't look too often. And actually, that's kind of not a bad thing. Look a couple times a year, 3-4 times a year, because there is a lot of volatility, and you may not have any loss if you don't sell, and you can have that emotional risk tolerance to hang on until things come back. Then there won't be that long-term loss, and it's kind of usually things do come back. All right, some different kinds of asset classes that people have heard about. And, Chad, if you've heard, equities. That means that's an ownership type asset class. Somebody mentioned farm property. That would be under the equities kind. I own it. I hope the main way we make money off that is, like we said, like just mentioned, if you sell it at a higher price. Then there are things fixed income, like bonds. That means that you typically get some interest. It could even be rental property, but you're not looking, you may eventually sell and get a capital gain, but the thing is with those, there is some fixed income. Then there's cash, and that's really important, or cash equivalent, money in our savings, a checking account, CD. That's the stuff that, in case of an emergency, because the big deal is I don't want to have to sell when things are down. And then there are other alternative types of investment or assets, like commodities, gold, and things like that, which we won't be talking today. A little more speculative, but we won't be talking about those today. But those, you'll hear about these different asset class, equities, fixed income, cash equivalents, kind of fall in that realm. All right, so some common ways, just to recap: you buy a stock at a low price and you sell it at a higher price. And that's the thing. You want to buy when nobody else wants to buy it. Like Jill said, can you handle that emotional thing? Okay, nobody's buying this thing, but it seems to have some value. But if I buy stuff when everybody, oh, this is a hot thing, I'm going to buy it, well, chances are the prices are going to be higher. So the idea is to, understand my financial self and my emotional self. And then dividends. Some companies will return a percent of profits to a shareholder. Typically, those are well-established companies, and they're trying to attract people to the stock, and people who want, a little bit of dividend. And we've got an example, I think, coming up here of a stock that provides a dividend. And here's an example. This is not a recommendation, just pulled big company that's been around for a while. And this was April 15th, because as Jill mentioned, things can fluctuate a lot, but the price of the Johnson & Johnson was $148.40. And this company has for a while offered a quarterly dividend, currently $1.19 per share. So in this example, if Todd owns 100 shares, he'll be paid 119 quarterly, but Todd does understand that the company can change their dividend payout policy. So that's just an example of that. Let's see, there's some things. Okay, so what do you do? Where do you go to shop for stocks? Well, you can buy those from online, as Jill mentioned. Robinhood came along and they did away with commissions. There's lots of different platforms to trade. Robinhood is one. And now, since Robinhood came along, though, there are not commissions. So if you want to just, what you want to buy, you can just go online and purchase stuff, and price, there isn't typically a lot of commissions. Although there are stockbrokers still. There's some relatively big outlets. If you go to a stockbroker, they may charge a commission, especially if you want advice. Registered investment advisors, if you want advice, they may charge a commission. For stocks, if you sell after 1 year, do you need to sell at a higher rate than the principal to accommodate it being taxed? Well, yeah, good question. Yeah, because if you sell something, you want to be a rate above taxes. Certainly, you want to make more. You want to think about, okay, how much am I going to pay in taxes? What's my purchase price? What was my sales price? How much will I pay in taxes? So sure, that encompasses the whole thing. Yeah, so good comment there. All right, so bonds earn interest. So your bonds, a company will issue bonds, or even the U.S. Treasury issues bonds. So people kind of lend them money and they earn interest. So that's a way to make bonds. You can also buy and sell bonds. And a lot of us saw, because I have bonds in my portfolio in funds, and the interest rates rose. So those bonds were worth, oh, I've got a bond, but the interest rates is this, and now the new bonds coming out pay a higher interest rates. So the existing value of currently held bonds drop. But then you know what happens, especially if you hold them in a fund, things change, they sell them out and they'll come back. But just a thing to note, if everyone saw when the interest rates rose, those of us holding bonds at the old low rates, they weren't as much. Are you able to discuss the concept of a trading journal and why important for stock trading? I am not able to discuss that. No, sorry. All right. All right, so start as soon as possible. And someone was saying this? Okay, and we're going to show a reason to start as soon as possible. Yes, the twins, Mike and Colin. And I wish I would have been introduced to Mike and Colin when I was 25, because the sooner you start, and this has really been borne out over time, the sooner you start. So we'll say Michael and Colin, they're going to start investing 5,000. This is just a big average, 8%, and that's not a crazy amount. They're going to put that money in tax advantage retirement accounts. So while it's under that nice blanket, they don't have to pay taxes. Over the course of this, they're going to do 100,000 each. But Michael's going to start at age 25 and he's going to stop when he's 45. So he's just going to 20 years, but he's going to start at 25. Colin, his twin, is going to wait. He's going to wait till age 35 to start, put the same $100,000, and and then he's going to go 20 years as well. So who do you think is going to have more money? What do you think? Is it going to be significant? All right, well, we'll give it away. I think probably people know. Michael he started that 10 years of just letting it grow is going to leave him with significantly more money, 493, 983 to the 228, 810. It's significantly more. Have folks seen this example? Because there's a variety of this example, but the idea is that's the starting early. Didn't expect that much. Yeah. So it is pretty shocking. Just letting it grow. And that's the thing, because if you have a tax advantaged account and you take it out before retirement, and you could face penalties, but you can stop. Nobody says, hey, you must continue. Just letting it ride can have a lot of value. Time to compound, it was 20 years in both cases. Well, actually, no. Michael had 30 years of compounding, whereas Colin, good point there. Whereas Colin only had 20, and that was the difference. The time to compounding was different. So thank you, Sam. So Michael had 30 years of compounding. Colin only had 20, and that 20 years, that was the difference. Why he made so much. That's why Michael made so much more. That extra 10 years. Good point. He didn't do. Oh, good point. Go back to that example, Jill, will you? He didn't have 100K. He just did 5,000 a year for 20 years. So yeah. Can you flip back? If not, their total contributed was 100. It's all right. We don't have to go back. And you'll see the slides. He didn't have 100. If he had 100, that would have even done, he would have done phenomenal. If he put in 100 and just let that ride for 30 years. But no, he put in 5,000 a year for 20 years. Yeah. That's why folks who have a lot of capital, yep, they have a big advantage if they have a lot. Other of us, we just have to do it year by year. All right. So mitigating, okay, risk. Okay, so it doesn't come guaranteed. In most cases, over the long haul, over 20 years, 30 years, just steady investing, you're likely, and we'll talk about asset allocation, which is so important, but it doesn't come with a guaranteed profit. As someone said, I don't think it's like gambling if you have a proper asset allocation, if you do steady dollar cost averaging, but it can be volatile. I remember I was around in 2007. I had just started putting money towards my retirement plan and I watched it all buy. So it goes. I know a lot of us, so it can be volatile. There is possible to lose money invested. That's why it's important to have that other. But generally, investments that are risky tend to provide a higher rate of return than investments with less risk. So if I'm 20, 30 years, even 15 years out from retirement, just as Jill said from the beginning, if I put it all in a savings account, it's very, very unlikely to keep pace with inflation. And then I'm going to get taxed at ordinary income taxes. So it's the risk. There is risk if I just do nothing as well. All right. All right. So how can I mitigate that risk? Diversification. And someone said it earlier. Don't put all the assets in the eggs in one basket. Diversification and proper asset allocation. Am I investing properly? And I was scared of risk. So I would put too much money in safe bonds when I was younger. Thankfully, my spouse, he did it differently. He knew you have to take risk. So his portfolio did better in the haul. Now, as I'm getting closer to retirement, it's time for my asset allocation. And even throughout the life cycle, you've got to make sure you take the risk when it's appropriate and you have enough safe when it's not. And where to put your money is a really important thing. Do I have that mix? And then appropriate amount of money in safe liquid accounts. So again, consider your situation.
And I think that goes back to, should you always max out? Should you always, maybe not always,
Yeah.
your contributions. So, because you do need to have some in different accounts and safe.
Yeah, exactly. Yep. Definitely. All right, so here is a very sophisticated, not really, but here's just a basic example of diversification. Let's take a look at portfolio one. Is two companies, not very diverse. A lot of studies say 20 to 25 different types of equities. And you see in portfolio two, it's much more diversified. There's stocks, there's bonds, there's cash, maybe there's some real estate. Well, there is in this example, there's 20%, but there is a diverse mix. And again, so that's why you have lots of baskets with stuff in it. The more baskets, the less chance they're all going to go to heck in one shot. And what that looks like just depends on your situation. Right, next slide. And so diversification, that's why inside retirement plans, we have mutual funds. And mutual funds or funds, mutual funds, exchange traded funds. When I buy a share in that fund, I don't just get one egg. I get a whole bunch of stuff. I get a whole bunch of baskets of different stuff. And typically we do a dedicated amount each paycheck. That's called dollar cost averaging. So if I invest $100 every paycheck, when prices are lower, I get more stocks or equities, whatever, more things in my little baskets. And over time, I grow. It hopefully will grow. There will be ups and downs. And then retirement plans offer a tax advantage wrapper. If I'm saving for retirement, I want that wrapper, be it Roth or be it a traditional. I don't want to have to pay taxes on that while it's growing. Now, outside of retirement plans, we can get diversification through exchange traded funds. And you can purchase those through a brokerage account. The big ones, and kind of look for the ones. There are lots of the fees have gone down, down, down. And not that this is an endorsement, but it's historical. Vanguard led the way with low fees. Now you have Fidelity, T. Rowe Price. A lot of them have exchange traded funds at very, very low fees. And low expense ratios. So these can be purchased through a brokerage account, and they're typically more tax efficient than mutual funds. So if I'm inside a retirement plan, mutual funds may be just fine from a tax perspective, but outside I may look to a fund. And again, I'm pressing funds here, but if you want to start accumulating a batch of stocks, there are ways. It's just you're going to buy one thing. If you buy a fund, you get your purchase price gets a bunch. Do we need to diversify the provider too? Yeah, if you're happy with one company, I think that's fine. You want to look for a company that's, their expense ratios are low. Really nowadays, they're really is there, do they have a lot of them now have tools to help you plan, explanatory tools. If you do have a question, is there a way to get information? So I would say not necessarily. If you've got a good company, maybe I'll just stick with that, and that may be just fine. I would just say, yeah. So let me just end there. I know I run on. Asset allocation. All right. Again, considerations. What are my goals? How far out to my goals? And what is my risk tolerance? And that depends on you and your situation. And again, this is just an example. Large cap stocks in this country, big, large growth companies have done well over the long term, but maybe I want some exposure to international companies. Definitely want some in cash, wherever we are, that emergency fund that Jill said. I don't want to have to cash out because the refrigerator goes, my car breaks down, whatever. All right, next slide. All right, and here's an article about introduction to asset allocation. We just put a link there. You'll get the slides, and that is just you want to talk about it because asset allocation is really very important. Some consider it that and diversification your biggest drivers of success. Okay, so and some examples of investment strategies. I mentioned the dollar cost averaging, just same amount on a regular basis. Value investing, where you look companies, their intrinsic values, study them and say, I think this is a good company, good value, investing that way. Or then market timing. And well, I'll see the next slide. I think I have a few words about market timing. Along the lines of good luck. Active management. So that's actively managing an investment portfolio, professional management, or do it yourself. And you could go to a registered investment advisor and have them manage a portfolio. And sometimes there's a reason to do that. A lot of, and the trend now is a big trend, and trends are good or bad, but in index funds, very low cost. And the reason for this, and the academic research, when I first started reading it, it blows you away because passive management, sticking with index funds, making sure the asset allocation fits yours, really can have, the studies say this achieves a better result. An index fund, and in the next slide, I think I explain a little bit. It follows a benchmark or an index. So it tries to match all the things in an index, like the S&P 500 is a common one. And Jill, flip to the next one. I think I've got a little thing there and some examples. So it tracks a market index. You purchase shares are representative of that index. So it doesn't, it just, computerized. And then there are many types of index funds. And then there are different types. In the next slide, I show some examples. The S&P 500 is one. The Dow is another. Russell 2000, small companies. The MSCI is international companies. There are bond markets. This is Schwab U.S. Aggregate Bond Market Index Fund, and many, many more. Now, typically, exchange traded funds are passively managed index funds. So you get a taste of the market that follows this index. But there are some now. I'm seeing a big company is doing more. But the idea is that you just get with an index fund, you get a share of a certain sector, certain area of the market. All right. So if I wanted to purchase investments, like I said, you could go to a broker and pay a commission. You go to some place like Robinhood or E-Trade or somewhere. And the Robinhood, they kind of broke the deal with commissions, and commissions are not there. They make a little bit, just a little bit every time people buy and trade. And they've almost tried to gamify that. Because they want you to buy and sell because they make a few little bits off the bid ask of the spread of what's being bid and asked for. So they incentivize you to do that. So just be careful. Is it money that, hey, I can, like somebody said, or am I got a plan? You can go to a registered investment advisor, and a registered investment advisor is supposed to have fiduciary, supposed to provide you with advice that is legal obligation to provide you with advice that fits your situation and is best for you, and not think about commission first. Some registered investment advisors will manage people's assets, and unfortunately a lot of times they want folks who have a high level of assets, pretty high. And then they charge a percentage under management. So if you have $500,000 of assets and they charge 1%, that's about $5,000 a year to manage those assets. And my point here is with index funds, you can go to the big companies that don't charge a lot and get into an index, and that may work for a lot of folks. Notice a lot of folks, typically older folks, there's annuities, they're sold by an insurance agent. Insurance agents typically get a commission and salary, so their incentive is the commission. Now, if you want financial planning, you can turn to a certified financial planner. A lot of those are also registered investment advisors or a certified public accountant with a personal financial specialist designation. And they have different compensation methods. And I've seen the things change. It used to be commission. Then it's move towards assets under management. But now with the technology, we have more folks who are doing hourly or flat fee. So I think the industry may be changing again. Okay, cool. Somebody put in some information in the chat. How to tell when to check on your asset portfolio. Well, it depends on the tools you have. I know with some retirement stuff I have that's in, they show it. They put up a chart and they'll say, okay, Lisa, this is how much is in this. This is how much is here. A CPA with a what kind of specialization is a question, with a personal financial specialist designation. And the cool thing there is they may have a good little significant idea about taxes and personal finance. So there used to be a great tool on their professional association website to find one, but that hasn't been working for a while. So maybe it'll come back. And somebody put in some information about expense ratio rate return. Thank you for sharing that. All right. Um, so investment costs, the cost of expenses and fees has declined. The digital tools, I think, are going to help us continue that trend, where now a lot of times, you know, you can get investments, you can get shares and funds and things like that, for relatively, the prices are dropping, unlike the price of housing that we talked about earlier. One place where prices are going down. Uh, all right, next slide. All right, before you work with an investment professional, I would check on them. FINRA broker check. You could just Google that, FINRA broker check, or you'll have the links there, or the Securities and Exchange Commission. I always look the person up to see if they have any, what's their background, what's their history, have they had any problems. So always a good idea, whenever you talk to somebody, even with FRS. We get some stuff through FR. We get some free help through FRS. They're under contract, so they don't work on commission. But whenever I'm talking to somebody who's an investment professional, I'll do a broker check on them and see what's in their history. Okay. Right. And somebody said everybody has a Fidelity account. I didn't know that. I am actually not a UF employee. I'm a UF faculty member, courtesy of the fact that Hillsborough County pays my salary. So okay, so we're just kind of getting to the end here, and then we'll take questions. And there were a lot of good comments in the chat. So just one thing about financial planning, and this is what Jill alluded to in the beginning, because a lot of people will say, "Oh, financial planning. Oh, investments, investments." Yes, investments, as we've been saying, very important for future goals. It's the only shot. Believe me, if I could take no risk, I would. But it's just one part of the whole thing. It's kind of like with health, fruits and vegetables are important, but a whole bunch of other things are important, right? Sleep, exercise, protein, all of it. So, but financial planning, the same thing. And this goes to what we were talking about at the beginning. Investing is one part of it. Cash flow management, though, is a big, important part of it. Tax planning, estate planning, risk management. Goodness, you can sink the whole ship if I don't have proper insurance. So investing is important, but keep in mind it's one part of the whole plan. All right, next slide. All right, so some key points that we were trying to do, and Jill will jump in here if more. The thing is, start as soon as possible. Start if you've got a little bit, if you can do it. Start. Mitigate your risk. Diversification. Use tax advantage plans for retirement. And you think, well, I want to invest first outside, but think about it. If you want to get to retirement, it's hard, if you do, and some people don't, but you never know, you want to have those opportunities. If you want to fund 20, 30 years in retirement, you got to start as soon as you can. Investigate employer plans first. UF employees have lots of options. I don't think match, maybe not, but if private sectors, if you've got a spouse or a friend, tell them, think about the match, grab the match, where the company matches investments, matches investment dollars, and then find out more information using reliable sources. Be careful of the latest trends on social media and things like that. What do you think, Jill? TikTok for my investment advice?
I don't think so. Yeah, you're right. Like, there's that, going back to mitigating risk, there's some of it where, maybe you do calculate a little bit where you take some more risk and maybe follow, I don't know what, social media or do something. But it's really, you're trying to, like, say, outpace the inflation, outpace the system, and back to not putting all your eggs in one basket,
Yeah.
But as soon as possible, if only we had, right? Somebody who mentioned that they're in their 20s, like, this is the right place for you to be, because you're going to be better off than I am. If you start now and just leave it alone, for a lot of it, just don't touch it, leave it alone. See, Sam's 25. He wants to be Michael. Those are goals, Sam. I like it. Yeah. At
I
any rate,
think you can do fine with one company.
yeah.
So one company can be fine if it's a good company that does not have a lot of fees and expense ratios. Take a look at the expense ratios and see.
Yeah, and you know, that company should be able to help you diversify within.
Yeah.
So that you are taking more risks with some of your funds, and you know, so they should be able to calculate that and help you.
And a risk with doing a rollover, no, I mean, like, let's say if I decide I'm going to leave my employer, and or for whatever reason, so I want to roll over my retirement funds into an individual retirement account. If you're going with a reputable, there shouldn't be a risk. You just want to do a trustee to trustee rollover to avoid consequences. And it's beyond the scope of this webinar, but if you go from traditional or Roth to Roth, there aren't going to be tax implications. But if you go from traditional to Roth, there are going to be tax implications. And understand that some folks in the private sector, they want you to do rollovers. Make sure it's in your best interest to do a rollover. If, you know, are the expense ratios low? Why are you doing the rollover? Hopefully not because somebody's going to make a commission or something like that.
You know, I think that not under like what I've seen, Lisa, is that some people don't realize that if you were to leave an employer, that you can oftentimes roll those funds over. And I've seen people just cash out every
Ugh.
time.
And you
And
know
what
what
happens?
Yeah.
And then they've used those funds to, you know, for whatever. So just know that if you are switching employers, there's typically a way to roll it over so that you don't lose out on what you've invested already. So
Yeah, because the thing is once that could trigger a huge tax event if you
next,
cash out, and
yeah.
penalties
And
because it's supposed to be a retirement plan. So there's just big
yeah,
implications from that.
well, and we saw you're missing out on that difference between Michael and Colin is the time. You can't get that time back. You know, that earning power of those dollars. So just remember that, you know, you really want to check into all of your options before you make a decision.
Somebody said, I heard that UF will be offering a Roth. I think UF already offers Roth plans, don't they, Jill?
Don't know.
I think they do, because I've kind of used to be jealous. Where I work now, they have those.
Yeah.
So a Roth, I don't know the answer to that, but I think you have Roth options, which means like just what Jill said in the beginning, you don't get a tax deduction in the year you contribute, but if you've got a long years to go, you might have a lot of growth.
Yeah.
I can say that for the retirement plan, I believe through Fidelity, you can make Roth contributions. So that is something that you can do through UF.
Okay. Keep contributing. Will it be okay to? Yeah, a lot of those accounts, if you haven't rolled them over, sometimes you can just let them sit. And just you won't be contributing anything, but it could still grow a little bit and
Okay, and then Audrey asked, does a clock start over? Oh, that's a good question, Audrey, because if you have the Roth, there's a 5 years. So with a Roth, there's a 5 years, 59 and a half and 5 years. With traditional, you take it out, you're going to pay taxes, but with Roth, to avoid penalties, you want to have them open. So the Roth has the 5 years rule, and if you want more info, talk about that because you kind of get in the weeds, but just email and we'll talk a little more about that. Fidelity, Lincoln, about the same when it comes to retirement funds. I don't know. I would say the target funds can vary. I would look at expense ratios. I would look at what does their platform feel like? Does it offer information with TIA, Fidelity, Lincoln? What are their expense ratios on their funds? And that's something funds will have an expense ratio compares. Like, so if I'm looking at S&P 500 on one company and S&P 500 on another company index fund, what are their expense ratios? All right. I'm
And
just
then
kind of answering some of
is
the
there
chat.
a way to double check if you have retirement plans that you weren't aware of? So like if an employer was contributing to a plan on your behalf and maybe you weren't contributing, they should be indicated on your W-2s if you're enrolled in a retirement plan.
Well, yeah, if you have your right, yeah, if you have
Yeah.
it, if you have it for your current. So on your box
Yeah.
12, you're going to see some codes. You can Google W-2 box 12 codes, and you'll see like different codes if you have for your current employer. But if it was an employer 20 years ago, well, you gotta, if you can dig out your W-2 from 20 years ago.
Well, I think Sam was only 5 then.
Oh,
So
okay.
I don't know if he was working.
Okay, so chances are he's got his W-2. Yeah, good point, Jill. Good point. I didn't realize.
That's okay.
All right. Yeah, look on your W-2.
Yeah.
Good point. Think of somebody like me. All right.
Yeah.
All righty then. I think, do we have any more slides? I don't know if there's any.
Oh, sorry. Let's see.
I don't know. I think that was it. Yeah.
Oh,
Here are some resources. Yep. And public libraries. You'd be surprised, but actually mine, they just took one away that they have, but some libraries have access to different things like Morningstar subscriptions and services where you can learn a little more. So that's really great. UF, as somebody put in, thank you. Somebody put in information about going to a video. Oh, OPS, yes. Yes, they have a yes, they do. So if anybody knows, tell their OPS worker. I had a PA and he was just so thrilled to find out about his little bit of money that had started accumulating.
Yeah.
They don't contribute to Social Security, but they do. So the money, instead of Social Security, there is money that's put in a retirement type plan. Alrighty. I think that's all we had. So glad you have got started without me. Yes, that's a cool thing.
Thank you so much for joining us.
Yeah, we've got a couple. Does anybody have any, unmute if you want to? We got about 3 minutes, but I guess people probably want to get going. And there's 2 surveys going. If you go to this one, the go.ufl.edu/eval, the slides will be there. Alrighty. Well, I guess.
All right, I think one person asked to go back to the slide with the QR code. Are you able to do that?
Thanks. Yeah, that was the one. Sorry about that. I forgot about that question.
Oh,
That's the one about the the asset allocation article. There it is.
Yeah. So if
I don't know if
anybody
that
needs
person's
this.
still there. Thank you, Jordan, for catching that.
No problem.
Stocks, when you are doing that initial investment, do you pay tax as well as when you sell the stock, or is it just at one time?
If you have a capital gain, it's just when you sell. So you have a stock, if there's a commission, you'll pay that, but you don't pay a tax to buy.
It's on the profit that you make. So you're essentially making income. So you're going to be taxed on that income.
Okay, so if I let's say I buy a stock for $300, I would want to account for whatever one of those brackets I fall in, 5%, 10%, or 15%, 20%. When I sell it, because if I sell it for 300, then when I withdraw it, they're going to take the tax regardless, so I lose that money. Does that sound right?
Well, so if you bought it for if you had a capital gain, so if you had bought it for 300, you sold it for 300, you had no income. If you bought it for 300 and sold it for 400, the year you sell it, you have $100 of taxable income. So
what you're asking is, would you want to add that to your adjusted gross income to consider how much you would pay for taxes that year.
I think I understand based on what Lisa is saying that I think that answered my question as far
Okay.
as like if I sell it for, let's say I sell it for $301, $302, $400, I'm only being taxed that 20% amount, 15% amount based on what I gained from selling it.
Correct.
And then if I gain nothing from selling it, I'm not taxed at all because I didn't have any income.
Right.
Okay, that makes sense. Yeah, at first I thought like if I sold it, they were gonna like, let's say like I invested 300, I sold it once it reached 300. I was like, I want to get out of here. I thought they would tax the whole 300 when I
No.
withdrew it.
Right, right.
When I sold it. Okay.
And you'll get a
Thank you.
1099B, 1099. So
A
that
statement.
yeah, statement. So instead of a W-2, you get a 1099 statement telling the purchase price, the sales price, whether it was long or short term. And that's what, when you do your taxes, most folks use software, you just put it in the right place in the tax software and it'll do the work for you.
It'll calculate what amount is taxable.
And was it, you were saying, box 12 on the W-2 will show you your contributions for your retirement plan?
Yeah.
Okay, thank you.
Yeah. Okay, and then Lisa, we had a couple questions about, is a money market account or is a CD account a savings product or investment product?
Savings, and I put those in the chat. Those are
Oh,
savings
good.
products.
Thank you. I didn't see your answer. Sorry.
My typing skills are not great, but I was able to do one word.
Yeah.
Can I ask a follow-up question to that? That was my question in the chat.
Okay,
Mhm.
good.
Yeah.
So about the CD accounts and the money market accounts. So because those are saving products and not investment products, they're then not qualifiable for the capital gains tax advantages. Is that correct?
Correct. You're going to pay on those every year at ordinary income tax rates. So you'll get a 1099 INT from your bank if you made $10 or more of interest, and you add that to your taxable income and you get taxed just like you would if you had pay W-2 income.
I see. So this is kind of a specific question, and feel free to let me know if it's too specific, but say you so I sold a house this year and I got a big amount of cash from that sale, and so I put it all into a savings account, but I want to avoid getting taxed on that amount, like on the full amount, and I was thinking about putting it into investments account so that I would benefit from capital gains. Is that like a sound strategy or not really?
Well, we can't really give that specific advice, but I'll say generally speaking, if you want that money to grow and you don't need the money, and you're investing, then and you don't, so that may be a good strategy, because while it's in the bank, you're going to pay every year on that interest. If you don't need it, you can within the limits, you can put it in retirement plans, or you can purchase exchange traded funds, and some things you don't pay any taxes until you sell.
Okay, thank you. I guess just a follow-up clarifying question. So the tax you end up paying on your savings products is just the interest. You're just paying tax on the interest. You're not paying tax on the full sum of the.
Correct. Every year. But if you're making $20,000 in interest every year, or whatever, yes, it's just on the interest. Let me just answer your question.
Okay.
Yes, you pay on the interest. You don't pay on the
Thank you.
All right, well, it is a little past 1, so I think we're gonna go ahead and wrap up. For anyone still here, thank you so much for attending. We did drop a link to our survey in the chat that helps us plan future work-life initiatives. And then Jill and Lisa also had a link on the screen if you were able to go there, and that helps them with their different financial webinars that they do. So with that being said, I hope everyone has a great rest of your day. Thank you for joining us.